Good morning. This is Japanese Economic Review Channel. Today, we review the market activity from yesterday, Friday, June 5th. The session was defined by a sharp correction in AI-related stocks, contrasting with a broader market resilience. While the headline Nikkei 225 figure suggested a massive sell-off, the internal dynamics revealed a significant rotation of capital rather than a total market collapse. Let's examine the factors behind this divergence. Looking at the data, the Nikkei 225 closed down 882 points at 66,588, burdened by tech profit-taking. However, the Topix remained nearly flat, losing only 2 points. This stands in stark contrast to the NY Dow, which hit a record high of 51,561 the previous night. While the US benefited from easing inflation fears following a Middle East ceasefire, Japan's index was uniquely pressured by the global pullback in semiconductor heavyweights. Slide 3 highlights a remarkable paradox. Despite the Nikkei's plunge, nearly 80% of prime market stocks actually rose. Specifically, 1,196 stocks advanced, while only 340 declined. This proves that the market bloodbath was confined to a handful of large-cap tech giants. This breadth suggests that underlying investor sentiment remains robust, with capital moving out of overextended AI sectors and into the broader economy. The intraday chart shows a dramatic morning. Contagion from the US Nasdaq and Broadcom's drop triggered aggressive selling in Japanese tech, pushing the Nikkei down over 1,600 points by 10:25 a.m. However, the afternoon saw a dead cat bounce as bargain hunters stepped in. Trading volume eventually dried up as investors moved to a wait-and-see stance ahead of the crucial US May payroll data released later that evening. The rotation of funds was clear across the 33 industry sectors. We saw heavy selling in electric equipment and chemicals, led by names like Tokyo Electron and Shinetsu. In their place, shipping and insurance outperformed, with NYK and Tokyo Marine seeing strong gains. Consumer staples like ASICs and Nintendo also provided a defensive cushion. This indicates a strategic shift from high-growth tech towards stable, dividend-paying value stocks. Finally, the growth market 250 snapped a 6-day losing streak as speculative capital flowed into space tech and AI ventures like Astroscale and QPS Holdings. Beyond the indices, structural shifts are emerging. Kikkoman and Nestlé's new joint maritime transport initiative highlights a focus on logistics sustainability. While tech remains in a correction phase, these infrastructure and technology evolutions offer long-term opportunities regardless of short-term index volatility. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.